Hello and welcome. Today from Motilal Oswal AMC, I'm joined by Varun Sharma, Executive Group Vice President, and Niket Shah, Chief Investment Officer. Also joining us is Ashish Menon, Senior Mutual Fund Analyst at Value Research, and we'll be diving into the newly launched Motilal Oswal Digital India Fund. Welcome, gentlemen. Niket, to start with, could you explain what the Digital India Fund aims to achieve and what makes it a unique fund in the Indian market landscape?
Yeah, so Ruchira, if you look at pretty much everything in and around us right now is digital in nature, right? From a value migration standpoint, and we've seen that across the board, across categories. So just to give you some very rough data points, today digital economy is roughly about 8% of GDP, right? And is likely to move to about 20% of GDP. So in the next 6 years, so by FY30, we expect 20% of GDP largely being driven by the digital space. If you look at different sectors, right, whether it is SaaS, whether it is fintech, food tech, the industry growth is about 7 to 8% in most of the categories in India. And digital companies are actually growing at 30 to 40% across the different categories. So what we are seeing is across spaces, across segments, across sectors, the mom and pop guys or the traditional guys are actually growing at a much lower pace, and the digital guys are actually growing at a much faster pace. Some of that is also due to the fact that the base of the digital companies are smaller, and there is huge value migration that the customers are actually seeing. Historically, if you ask me, we used to go to say a kirana store, right? Now we are actually moving more towards the food delivery guys or the quick commerce guys. Lastly, look at the penetration. The penetration of mobile phones in India is about 70 to 73%. More than 100 crore people in India now have a smartphone penetration, of which roughly about 52%, or say closer to about 75 crore people, typically have access to high speed internet, right? If you look at UPI, 35 crore Indians use UPI today. If you look at the amount of time that we are spending on digital or say screen, is about 6 hours 45 minutes that an average Indian spends on screen, of which about 4 hours on mobile phones. So out of 14-15 hours of a day where we work, safely about 40 to 50% of the time we do spend on screens or digital in some fashion. So we believe this is a way of life, and across categories, whether it's travel, online booking, whether it's transaction, whether it's stock market. Historically there used to be physical shares, then came brokers like us. Now we're seeing digital brokers, which is completely online, do it yourself kind of a model. So I think digital is the way to go, at least for the next 5 to 7 years. And I think the growth rates for the category in digital will be quite high. And lastly, digital typically, if you look at the offline part of the market, for one particular category, you will see multiple players as competitors. In digital, we've generally seen till now, two guys or three guys being there in a particular category. There will be a long tail, but there are, typically the top two or top three guys will, take the bulk of the pie. So from that standpoint, I think the growth rates being very high, it's quite exciting for us. And that's why we are launching this fund at this point in time.
So now, Varun, Niket just explained how digital fund. What do you aim to achieve with this Digital India Fund? So how do you select stocks within the digital sector, and are there any specific criteria that you use to identify companies with strong digital potential?
Yeah, absolutely. If you look at these digital companies, they are primarily disruptors. They are coming up in several sectors, and they are leveraging digital technology to disrupt the incumbents. And any of these companies, which is able to demonstrate leadership, and we feel that they're extremely efficient with capital and are able to scale up at an accelerated pace, they garner our attention and they merit investments. And it's been happening, across industries, be it retail, food, insurance, payments. Even IT services is getting disrupted by software technology platforms. So there also we're finding companies in travel technology. And this space is only growing with time. Every year we are seeing new 3 to 5 companies getting listed with differentiated offerings, and they are gaining market share in those respective industries. In terms of so this your second question was on allocation of weights in these companies. See, Opportunity clearly determines whether or not these stocks will be in our portfolios, and the business risk determines what kind of weighted they will be. So we don't want to miss out on the opportunity at all, but we also want to be mindful of the risk that businesses present. And from that standpoint, the bottom-up perspective is extremely important. We have an in-house QGLP framework, which allows us to, look at these companies in a very detailed bottom-up way. And only when they, go through all these lenses and the valuation methods that we have, the proprietary methods that we have, is only when we will decide to go ahead and invest in those.
So, Niket, moving on, we have seen many new age companies list in the last few years. However, many of them have never generated consistent cash flows in their lifetime. So, how do you even evaluate such companies, and do the valuations even make sense?
So I think some of these companies, and Varun can add more to it, but some of these companies, while they are loss making or not so profitable today, but I think we do look at next couple of years how things will really change and evolve. You look at some of the listed space companies, we have seen meaningful improvement in profitability from where they were in the last 1.5, 2 years. And but I think for one important thing that at least when I meet most of these new startups is that everyone has a sense of urgency to move towards profitability, which initially wasn't there because in the private space the focus was that you get more scale and you are getting more valuation for scale. But in listed space, I think you get more valuation only you show more profits. But I think we do see a lot of companies today accepting that fact, and hence I think the quest to move towards profitability and grow profitability on a sustainable basis is quite high. Varun, you want to add something?
Sure. I'll add one more angle to that. See, we at Motilal Oswal are very mindful of the life cycle of these companies. What we have observed globally also is that these companies tend to be digital monopolies. So there's always this urgency and the need to scale up as much as possible, as quickly as possible. So a lot of times, the issue that usually happens is that we misunderstand the choice of not making profits today, the growth margin trade-off. And we think that, these companies are not able to turn profitable or make sustainable profits. Going by the evidence in other markets also, and a typical behavior of any digital leader in any industry, they will always prioritize growth over profitability. But that doesn't mean that it won't come in future when it comes to profitability. We have evidence in India also today. Some of the companies which have garnered the largest market share, they are generating phenomenal profitability as well as free cash flow. So we need to wear a different lens while we are valuing these companies. The typical traditional methods do not really apply that well in case of these companies. And in search of profitability, what usually happens is that investors miss out on the entire growth opportunity in these companies. So we have to be mindful of these facts and these aspects of these companies when we are evaluating these stocks. That are they choosing not to make money today because they know that eventually when they become a significant leader, they can generate as much returns as they want, or is that something that they cannot do? So these are also very important analysis. I would say decisions that we have to take. And it is very much possible that they continue to choose to accelerate at a much higher scale because India is an underpenetrated market across sectors. And at some point of time, once they become large established businesses, they have thwarted their traditional counterparts. They may choose to turn profitable, and at that point of time, actually profitability will be a given. And it will not be a choice anymore because they would be generating so much of free cash flows. And that is the typical behavior of any digital company that we have observed globally also, and even some of the verticals in India.
Right. So like Varun mentioned, some of them choose not to make money and growth over profitability. So Niket, how do you evaluate the potential of new age digital companies that may not be yet profitable? And what are the metrics or factors that you think are most important for assessing their long-term viability?
Varun, you want to take that?
Okay, sure.
See, the life cycle of any digital company is very different from any traditional company, right? So if you look at most of the other sectors, we find that many players coexist peacefully, remain profitable, generate good profit, return on capital. But that is not something that we have usually observed when it comes to digital companies. Digital companies' hunger for growth and to establish leadership is always paramount, which means that we need to be able to understand the life cycle of these companies to the extent that by the time they become leaders, what will be their priorities? See, we as investors are only takers of the business environment and the strategies of businesses, right? So, after having observed many businesses and the way they scale up, what are the life cycles of these businesses, we can make assessments around which companies are likely to succeed, what are their capital efficiencies, what are their abilities in terms of how many use cases they can develop on their digital businesses, their digital platforms. We also have a sense of how to arrive at objectively, what are the conditions for sustained profitability. We have developed our evaluation methodologies around which are the companies which can, eventually turn into digital tech conglomerates also. So when we keep all these factors in mind and when we evaluate opportunities, we find that there are certain companies that demonstrate those characteristics uh, of becoming large from a long-term standpoint and also achieving those conditions for sustained profitability. And when we get that comfort, we go ahead and invest in those companies.
All right. So, what subsectors or themes within the digital space, fintech, IT services, e-commerce? So what is it that the fund, primarily focuses on, and how do you ensure diversification within its thematic focus?
So diversification is a given because these are companies across sectors. Even within the same sector, there are companies operating in different subsectors. Within financial services, there's a company in insurance, there's a company in payments, there's a company which is targeting a different opportunity within fintech. So usually we do not find any overlaps when it comes to the same subsector also. There are very, very unique cases where we find overlaps. So naturally, it's a very, very diversified fund. Second, we will not constrain ourselves to look at only B2C companies because there's phenomenal work happening when we're talking about digital penetration, phenomenal digital penetration happening in B2B constructs also. B2B2C constructs also, and there are companies which are servicing government. So we have B2G also. And we have business models that are purely C2C when it comes to matrimonials, when it comes to even constructs like real estate. There's several C2C models also. So we find opportunities all across, amazing opportunities, and they will all form a part of the portfolio.
All right. Now, given the rapid growth in digital companies, how sustainable do you think the growth in this sector is, particularly in the Indian context?
So see, a very good proxy of understanding where we are in terms of our digital penetration. So we have some numbers available. Now, currently, from an industry standpoint, what we are getting is that digital as an ecosystem is about 8% of our GDP, going to go up to 20% over the next 6 years. In terms of even digital wallet spends penetration, the numbers that we are getting is that India is lagging behind the US and China by a huge amount, huge margin. While US and China are trending close to 30% in terms of digital wallet spends penetration, India is only stuck at 5 to 6%. So the challenge in India was actually just the payment ecosystem. While India saw all the other digital pillars develop, whether it's the smart devices or it's the high-speed mobile internet or even digital businesses, we had very good runway and we were mirroring the developed economies. But when it came to payment ecosystem, India lagged. But now we know that we've solved for it with UPI being all pervasive. It's everywhere. And now that we've solved for it, we would expect India to go, in an accelerated fashion from 5% digital wallet spend penetration to 30%. And it's happening not just in B2C, but also in B2B. Which means that the digital ecosystem can grow anywhere between 2.5 to 3 times the nominal GDP growth of the country, not just for a few years, but decades. It's a very, very long-term opportunity, very, very high growth area. We're very, very excited about finding companies, newer companies also in this space. We've done that in the past also. At Motilal Oswal, we've invested in many of these companies, and they have been extremely good alpha generators for us. But this is a very, very long-term strategy. And we've seen the parallels in the US also. When you look at most of the digital technology companies today, they've become Goliaths, they've become large, and the kind of stock returns, the kind of ecosystem returns that we've got in digital companies in US and China and several other developed economies. It's been fantastic. And when we observe their growth rates also for past 15, 20, 25 years, those companies, digital companies have grown at, even within the domestic space, at 3 to 5 times the growth rate of those countries' nominal GDP. This is the mega opportunity that we're talking about.
Right now, Ashish, coming to you. So while the digital sector presents opportunities, it definitely also has its risks, such as there's high valuations or tech regulation. So what are the potential downsides of investing in this sector, according to you?
So investing in digital sector, there's opportunity for significant growth, but there are a lot of risks associated to it as well. For instance, most of these digital companies, you will find that they are trading at very high valuations because what is often priced in is their future growth potential rather than their current profitability. So, when such lofty growth expectations are not met, you can find that, there will be steep correction in their valuations. Now, another risk that you will find is regulatory risks. See, governments globally, they are tightening scrutiny on issues like data privacy, digital taxation, and to a certain extent, antitrust behaviors because they generally don't want monopolies to be created. So when such regulatory changes happen, what can happen is that it can impact the profitability and many times, force these companies to alter their business models. Coming to profitability challenges, especially for the new age digital companies, they tend to focus a lot more on scaling up rather than becoming profitable. So, when eventually they struggle to transition to profitability, it negatively impacts investor confidence in those companies. Now, like any sector, the digital and sector, it is prone to volatility, which could be influenced by market sentiment or some tech specific trend. And it could be possible that we may not fully comprehend what those trends are. So when such things happen, there can be sudden market corrections or sell-offs, which have happened in the past here as well as in other countries. So these can lead to significant near-term losses. And lastly, technology disruption, it is a constant risk for this sector. Every now and again, some new innovation is going to come, which will quickly render, the existing business models or technologies obsolete. Thereby, whatever competitive advantage these companies may have, that may vanish. So, when you factor all these in, these are the kind of risks or the downside you should expect when investing in these sectors.
Right. So, Varun, considering all these risks, how do you think should investors think about incorporating a digital focused fund into their broader portfolio?
So, see, there are two things. One thing is that we believe within our risk framework that this ecosystem is extremely safe to invest in. And I'll elaborate a little bit on that. See, when we think of risk, risks are not a monolithic kind of opportunities or these scenarios that can play out. We have to think of risks in various scenarios. When we think of global risks, most of the digital portfolio in India is India oriented. So global, changes or global trends do not tend to impact the Indian digital penetration story. So from that perspective, this portfolio turns out to be extremely safe from global macro issues. Now, when it comes to India, we're talking about digital spends penetration. Even if there is an impact on the Indian nominal GDP growth, because this is a penetration story, this ecosystem will continue to show very high growth, and relatively very healthy growth. Because just think about it like this: even if our wallets do not grow for the next 10 years, we will still be spending a high proportion of our wallets online. Which means that because it's a penetration story, it is not even dependent on India's nominal GDP growth to show you very healthy growth. So we see that even that risk is taken care of. The third facet of risk is essentially industries. Because these companies span various different industries, we do not see any industry correlation risk. Then the final type of risk that one has to manage is the concentration risk, which we intend to do in this portfolio. So when we look at various factors of risk, what we realize is that this is a very, very safe portfolio, contrary to the popular perception that it's a risky portfolio. Now, second point on valuations, what we see is that, say, average digital company on average has scaled up 5 times over the last 5 years, but an average digital stock has scaled up only 2.5 times. Now, if we dissect the returns from any stock into two things, one is the business compounding and second is valuations. What we inherently know is that the stocks are not even reflecting the business compounding yet. let alone valuations. And now when we think of valuations, let us look at two scenarios. 3 years back, there were many concerns on the street whether these businesses will even survive. There were concerns whether these businesses will turn profitable or break even. We were in a scenario where we expected interest rates to go up. So from that point on, 3 years back, 3 years out, move forward today, we have seen that these businesses have scaled up. These businesses have also shown the ability to break even, and some of them have turned profitable. And I think all of us will believe that interest rates will not go up further. If at all, they will go down. So should our valuations today be better than what they were 3 years back is a question that we need to answer. And clearly, we are of the camp that valuation should be better. So when we look at both these factors, which is business compounding and the valuation improvement that we should both expect, we find that this space is extremely, extremely undervalued. Now, the problems that I highlighted initially were that instead of the investment world, instead of evolving and adapting itself to the new businesses, the new economy businesses, what we continue to do is the same mistake which an average US investor did when they were evaluating digital companies in the US 15, 20 years back. So what has happened is that these were the same concerns that time, saying that P's are very high, EV to EBITDA is very high, companies are not profitable. And these are the same concerns that US investors and investors globally had with companies like Netflix, Salesforce, Amazon. And look at the way those stocks have compounded. And I would also urge you to look at the way their profit CAGRs have compounded. So actually, when you look at a longer term approach, these concerns are actually unfounded. Where I think we have made mistakes as analysts and as industry specialists is that we have not evolved with time. We continue to use centuries old valuation metrics, which are income based, DCF based, cash flow based, which were propounded by Benjamin Graham hundreds of years back. We have not evolved those. We've not evolved ourselves. So I think that is where the mistake is. We are going to miss out on a great opportunity, just like a US investor did 15, 20 years back, by applying hundreds of years of old frameworks, force fitting them into companies where you should have adapted and evolved their own frameworks, which we have done. Right? So we have our own proprietary methods, we have our regression models, we have our econometric models for valuing these companies, because we don't want to miss out on this great opportunity that lays in front of us for the next 15, 20 years. So that's very important that we understand this piece, and we have a publication out there. We published a book only in this regard to make everybody in the ecosystem understand. See, we are industry participants, will also contribute to industry growth and industry knowledge. And we've done that let's not make the same mistakes that an average investor did in the developed economies. Now, having seen the impact and the benefit of digital ecosystem growth, that in stock returns, that in company scaling up, and understand the life cycle of these companies better to be able to have models which can, which we can apply to these companies. So clearly, it requires a lot of hard work. But if we don't do that, the mistakes will be colossal. It's an opportunity for generational wealth creation. We miss out on this just because we are applying, centuries old models. The kind of mistakes that people will make eventually.
So, Ashish, a final word from you. How does the Motilal Oswal Digital India Fund fit within a typical investor's portfolio, especially considering its sectoral focus? So, should it be seen as a long-term core holding or a more tactical allocation?
So you can look at this fund at best as a tactical allocation in your portfolio rather than a core fund. See, it focuses on digital and technology companies that offer long-term growth potential, but it does come with its own set of risks. So it is suited for an investor who has a relatively higher risk tolerance and a very long-term horizon, so that it complements his core diversified portfolio with a targeted exposure towards the growing digital economy. So you can have a small portion of maybe 5 to 10% of your equity exposure towards this fund.
All right. Well, with that, it's time for us to wrap up this chat. Thank you for taking the time and speaking with us.